Your client is a wedding photographer. She had an amazing Christmas sale, booked 5 weddings for next summer, and collected $20,000 in deposits. That's money sitting in her bank account right now. You're working on her year end and you need to figure out, is that revenue? If you said yes, you just added $20,000 to her taxable income for work she hasn't actually done yet. If you said no, that's what we're talking about today, deferred revenue. Deferred revenue is actually a pretty simple concept once it clicks. It's money your client has received for work they haven't done yet. The cash is in their bank, but the work is still coming. Think about it from the customer's perspective. Those couples paid deposits for wedding photography. If that photographer closed up shop tomorrow, they'd want their money back, right? Because they paid for something that they haven't actually received yet. That really is the true test. If the customer would be owed something back, that money isn't truly earned yet. So we need somewhere that we can put this money that isn't revenue, because if we call it revenue right now, her sales are going to be $20,000 higher, her profit's going to be $20,000 higher, and she's going to end up paying taxes on income she hasn't actually earned yet. That's where the deferred revenue account comes in, and I'll show you exactly how to record it. Okay, so why do we even care about this? Why not just record money when it hits the bank and move on? Here's the thing. The whole point of financial statements is to show what's actually happening in a business. And if we record revenue before the work is done, we're making the business look more profitable than it actually is. This has real-world consequences. The most obvious one is taxes. If our wedding photographer records that $20,000 as revenue this year, her profit is going to go up by $20,000. Let's say, for example, she has a 30% tax rate. That's $6,000 in extra taxes for work she hasn't even done yet that she doesn't actually owe. Those weddings aren't until next summer. And it's not just taxes. If she's trying to get a loan or bring on a business partner or eventually sell her business, overstated revenue is a problem. Anyone evaluating the business wants to know what's actually been earned, not what's been collected. So this isn't just an accounting technicality. Getting it right means your client's financial statements actually reflect reality and they're not paying more tax than they need to. Okay, so here's where it can feel a little bit tricky. Sometimes it's really obvious, like our photographer with deposits for a wedding that hasn't happened yet. Clearly deferred revenue. She's going to owe that service at a later date. But sometimes it's harder to tell. Maybe the work is partially done. Maybe it's not super clear what done even really means for the client's business. This is where accounting standards actually help. There's guidance from generally accepted accounting principles that accountants use to figure out when revenue is earned, and you can use the same logic. It really comes down to 2 questions. First, has the work been done? Did they actually deliver what they promised? For the photographer, that means showing up, shooting the wedding. For the contractor, it might mean finishing the job, building the house. For the consultant, that might mean delivering whatever they agreed to deliver, a final report. If the answer is no, the work isn't done and the revenue isn't earned yet. Second, is there anything left they still owe the customer? Sometimes the work is mostly done, but not completely. Maybe the photographer shot the wedding, but still owes them the edited photos. There's still an obligation there. For most of your small business clients, honestly, this ends up being pretty straightforward. The work is either done or it isn't. They've either delivered what they promised or they haven't. And when you're not sure, just come back to that test. If the business disappeared tomorrow, would the customer feel like they were still owed something? If yes, it's deferred. If no, it's earned. Okay, so let's say you figured out that your client has deferred revenue. Here's what you actually do. When the money comes in, instead of recording it as revenue, you put it in a liability account. You call it deferred revenue or unearned revenue. Same thing. The reason it's a liability is because the business owes something. They owe the customer the work they paid for. It's an obligation until that work gets done. When the deposit comes in, you're going to debit cash or the bank account because there's money in the bank and credit deferred revenue. Then, when the work is actually done, you're going to debit deferred revenue to clear out that liability and show that it's no longer there, and credit revenue, which makes revenue now show as earned. You're basically just parking that money in a holding spot until it's earned and then moving it over when the time is right. Now, in real life, you're probably not going to adjust for deferred revenue on every single transaction. If there are a few days between getting paid and doing work, honestly, who cares? But there are definitely times where you do want to pay attention to this. First is year end. That's a big one. Any deposits sitting in the bank for work that's happening next year, that's deferred revenue. And recording it correctly could save your client thousands in taxes. The second is big timing gaps. If the contractor collects $50,000 in November for a project that isn't starting until February, that's worth tracking properly, even if it doesn't cross a fiscal year end. And anytime someone is looking at the financials to make a decision, a bank, a potential buyer, a new partner, you want those numbers to be accurate. If you're not recording this properly, it could lead someone to make the wrong decision about the business based on those financials, so it's worth doing it right. So that's deferred revenue, money your client received for work that they haven't done yet. It sits in a liability account until the work's done, and then it moves over to revenue. It exists so that the financial statements actually show reality, and so your clients aren't paying taxes on income they haven't earned. If you want more lessons like this that help you build a bookkeeping business that's organized and profitable, make sure you subscribe, and I'll see you in the next lesson.